Okay then, so we definitely need to talk about Paysafe, because after releasing their Q3 results, the stock is down as much as 40%. And considering that my video on Paysafe is my most viewed video on YouTube, I feel like I owe it to you guys to provide you with an update and let you know where I lie with the stock. But before we get into the details of the earnings report to see whether that 40% drop was warranted, there's one thing that I would implore everybody to do when they find themselves in this situation. And believe me, at one point or another, you will find yourself in this situation. But that is to do absolutely nothing. And the reason I say that is because when we find ourselves in these extreme circumstances, we naturally feel compelled to make one of two knee-jerk reactions. Now, these are either to sell out of our position completely or to buy more in order to average down. When the reality of the situation requires you to take yourself away from the noise, analyze the business and consider what has caused the drop, consider whether there has been a fundamental change in the business, and whether the business has deviated away from your initial bull thesis, and then make a decision from there. So just for full disclosure, I haven't yet made a decision on which of those three options I'm most likely to take. I don't think that I'm going to sell out of the position, so it comes down to whether I'm going to buy more or whether I just hold on to my current position as it is. Anyway, we'll get into the earnings report and I'll share with you my thoughts on the whole situation. Okay, so I'm not going to go into the full details of my bull thesis in this video, because I've already created a 20-minute video on Paysafe and effectively my bull thesis remains the same. Although the probability of that bull thesis playing out in the way that I thought it would originally may differ somewhat, and that is what we're going to go through today. But just to give you a reminder of my bull thesis, effectively it centers around the idea that their digital wallet segment will grow at a faster rate than the rest of the business, and as this segment has the highest margins, this will result in margin expansion for the business and therefore multiple expansion, which will drive capital appreciation for the shareholder. So with that in mind, let's get into the video to see whether there has been any fundamental changes to the business and whether we need to amend our thesis. So the first part of the results that I want to draw your attention to is their revenues by segment. So we can see here their integrated processing, which is really the staple side to their business. It's the slow growing, reliable part to their business. It's actually grown by 3.5%, so that's not too bad. And they recorded $187 million in revenue for that quarter. Now that's actually higher growth than what I was expecting, so I'm pretty happy with that. But then we move on to digital wallet growth. And remember, I'm expecting digital wallet growth to outpace the rest of the business, and that way we're going to result in margin expansion and subsequently multiple expansion. However, we can see here that revenues actually declined by 15%, right? From 98 million down to 84 million. So that is absolutely horrendous, right? Moving on, and we'll come on to the details of that shortly. eCash solutions actually increased by 10%, which is very good. Now, what I was referring to earlier in that digital wallet actually has the highest margins, and therefore we want that segment to be growing at the fastest rate. So if we go down to the EBITDA margins, integrated processing only has 24% EBITDA margins. You compare that with digital wallet, which has 48%. It's coming in at twice as profitable effectively on a pound for pound or dollar for dollar basis. So that is incredibly impressive that their margins are so high, but unfortunately we're not seeing the growth in the digital wallet segment that we was hoping for. In fact, we're seeing a decline in revenues, and so we really need to get into the crux of what is causing that decline. Is it transitory, and can we expect effectively for there to be significant growth going forward? Now, eCash Solutions actually has adjusted EBITDA margins of 40%, which is very strong as well. And the fact that we saw 10% revenue growth there is very promising. But ultimately, all of that is overshadowed by the fact that we saw a 15% decline in digital wallet growth, and we really need to find out what is going on here. So this slide within the presentation gets into the detail of what on earth is going on with digital wallet revenue. This bridge here effectively represents the changes between what we're expecting in total digital wallet revenues, which was $385 million for the year, and actually what we now believe we are going to achieve. And management effectively summarised that down to 2 points, and these are regulations and pricing and tiering. So we'll get into the detail of exactly what that is referring to, and we need to refer to the earnings call transcript to get a better understanding of that. So what I've done is I've taken the earnings call transcript and put it into Word, and then I've highlighted some of the key areas. And the first one being here, as an example, in Germany, the adoption of new regulations had a more meaningful impact than we anticipated, with several operators reducing activity or leaving the market. Additionally, in the Netherlands, we're seeing a medium-term impact related to local licensing requirements. So the way that I've interpreted this is that in the Netherlands, we're expecting to be able to overcome the issues that we've seen and the headwinds that we're facing effectively once businesses align themselves with the new local licensing requirements. So that's not an issue. But in Germany, there is a cause for concern, and that's because we're actually seeing operators leaving the market. And then management further expanded on this point, stating that they had anticipated some of these changes, but the impacts have been certainly sharper and bigger than they expected. And in particular, there is a cap on how much a single person can bet. So clearly that is going to have a massive impact on the amount of revenue that Paysafe can actually take naturally. And then in addition to that, there have been increased tax on casino and poker games, and that has made these games unprofitable for the operators or the bookmakers. And so they say here that Betfair, which is a bookmaker, announced today that they are outright exiting that segment, right? So clearly that's not going to be good, and that is going to result in lost revenues for Paysafe as well. They do, however, say that despite this, the operators are getting locally licensed, they're getting adjusted to these new regulations, they're understanding which payment forms work. So we do think that over the next 6 to 8 months, there'll be an adjustment and a settlement, then get back to growth. And then the second reduction to revenue is all to do with pricing. So again, if we flick across to the transcript, we can see here that we're taking actions to address customer experience and pricing to be more in line with the market. As an example, we are overpriced in certain deposit forms, which has had some counterproductive outcomes. Equally, we are underpriced in other parts of the wallet where we see opportunity. We have tangible actions underway and are already seeing some positive results. So they are adjusting their prices to fall more in line with the market, which isn't a bad thing, but in the short term, it has hurt their revenues. So clearly the fact that they are having to reduce their prices in line with the market suggests to us that they aren't currently offering an experience which is worth paying a premium for. And honestly, with payment processing, I'm not sure whether it is ever going to warrant paying a premium for. I think most people will just go with the cheapest provider. So therefore, the pricing and the tiering changes that we're seeing to the revenue here, I think that is probably to stay. That might not necessarily be an issue so long as Paysafe are able to continue to increase their volume and the number of transactions in which they actually process. But we do have to take into consideration that their take rates will likely be lower going forward. Now, do I believe that the volume of transactions that Paysafe are processing within their digital wallet will increase over time? Well, I'm almost certain that it will, purely down to the fact that iGaming is a relatively immature sort of industry in the United States. And I think that once that picks up, Paysafe will be a beneficiary of that. And management believe that as well. So again, flicking across to the transcript, we see here that in North America, iGaming, we will continue to grow and deliver on our enhancements to the Skrill digital wallet, where the numbers are small today, but we're really pleased with the early progress, including our expansion to 11 brands, strong conversion rates, higher than market average deposit size, and great proof points with some upcoming operators. And then not only that, but they're also continuing to invest in expanding their crypto presence, where they are not only expanding in terms of their ability to trade more cryptocurrencies within the wallet, but are also seeing a very tangible interest from some of the top crypto platforms due to their unique combination of card processing, real-time banking capabilities, and wallet pay-in and payout capabilities. Management do, however, stress that although these initiatives will all drive real value next year, we expect 2022 to be a transitional year for Digital Wallet, followed by strong growth as we reset the division and deliver on initiatives. So 2022 we're still going to see a decline in Digital Wallet growth, at which point management are then expecting for double-digit growth thereon after. Now that means that there's going to be at least another year in which Paysafe are effectively underperforming. And I think that that more than anything else is what has spooked investors. And for good reason, because effectively we are now seeing that Paysafe's business are a year behind where we were hoping to be. And the reason I say that is because if we look to the FY22 preliminary expectations, they are guiding for adjusted EBITDA of between $440 and $460 million. And if we flick across to the prospectus, which was released when the SPAC was going through, in 2022, they were aiming for $655 million. So they've knocked a third off their EBITDA or expected EBITDA, and effectively we've been pushed back at least a year, if not a little bit more. Now, management are saying that they are sure that this is all quite short term, and in the long term, they will continue to deliver growth. But you have to seriously start to doubt management at this point, when just about a year ago, or just over a year ago, they were guiding for $655 million in 2022. we're now looking at about a third below that at around $450 million. That for me is rather concerning. Okay, so then I thought I would bring us back to my original 2025 price target for the business. And this was when the business was trading at $8.72 a share. I was projecting for revenue growth of 10%, EBITDA margins of 30%, and free cash flow conversions of 70%. And that gave me a 2025 price target of around $20. And that was using an enterprise value to EBITDA multiple of 25, a free cash flow multiple of 25, and then a sales multiple of 7. So what I have then done is I have updated my expectations for the business based on what we've seen in this latest report, effectively taking into consideration the fact that over the next year, we're not an any growth whatsoever. We're going to expect a decline in their margins, certainly in the short term, and then think about if we consider almost a worst case scenario. It's not necessarily a worst case scenario, but a low baseline scenario. What is going to be the return on this investment? Now, one thing to note here is that we have input the current share price, and that is $4.50. And the reason we are doing that is because regardless of what you've paid for your shares previously, $4.50 is the amount of money that you could get for them today, and therefore that is your opportunity cost. So this should always be based on your most recent or the current price of the business. So you can see here my latest assumptions, and then you can see my previous assumptions. So I have halved revenue growth. So it was 10% originally, it's now 5%. Gross margins have decreased. EBITDA margins have decreased. Free cash flow conversion has decreased. I've decreased the enterprise value to EBITDA multiple, enterprise value to free cash flow multiple, and enterprise value to sales multiple significantly. So from 25 to 20, and then 7 to 4. So in effect, I've said that because of the changes in the business, I am not going to give management the benefit of the doubt. So despite the fact that management have said that actually after 2022, they're expecting double-digit growth, because they have failed so far, I don't want to give them that benefit, right? So I've reduced all of those metrics. And according to this model, we're looking at somewhere at around $11 per share in 2025. If you believe the business will only grow at 5% per year, EBITDA margins will fall slightly, and the markets will be willing to pay a lower multiple than what we had previously believed for the business. Now, it is important to remember that I'm really not giving management any credit at all with these latest assumptions, right? And the reason I'm doing that is because I want to sort of give myself a worst case scenario, or not a worst case scenario, because worst case scenario would be for the business to go to nil, right? But effectively a worst case realistic scenario for the business, and then consider whether it's still worth taking on the risk and holding onto the shares. So we can see here that that is a return, a compounded annual growth rate of 22% based on our opportunity cost. Now, of course, the return on our actual investment is an awful lot lower, but effectively you now need to consider that as a sunk cost. You need to be based on the most recent prices, because if you want to sell the shares and invest the money elsewhere, well, you're only going to get $4.50 per share. So considering there is the potential of a 22% per year return on that $4.50, is this a business that I am going to increase my holding in? I doubt it. And the reason I doubt it is because I have pretty much a full position in the stock in terms of how I wanted it to be allocated within my portfolio. It was never going to be a significant investment within my portfolio. And I don't want to overexpose myself to this business. It was always going to be a low proportion of my portfolio. And I think I'm happy just to hold on to the shares, but not acquire any more. So people often fall into the trap of wanting to average down. They want to reduce the loss that they're currently seeing and therefore buy more shares. In reality, you shouldn't always do that, right? It's not a case of you should always average down just because you believe in a business and you continue to believe in a business. You need to take it into consideration how that fits with the rest of your portfolio. Because ultimately, although it looks like there is the potential for significant returns, especially given the fact that I'm effectively going against what management is telling us, and I'm actually putting in lower figures than what they are guiding for through to sort of 2025. You also have to take into consideration that this is a highly leveraged business. They have an awful lot of debt. And whilst at the moment it certainly seems like they can service their debt, I'm not willing to take on a significant position with this business, just considering the fact that highly leveraged means higher amounts of risk. That's just the way things are. Now, I think that this is a perfect example that we aren't always going to be right with our investment decisions, but luckily we don't always have to be right with our investment decisions. And that is why capital allocation and portfolio allocation is so important, because had I have weighted a significant amount of my portfolio to Paysafe, I would have been pretty pissed off after declining by 40%. Luckily, that is not the case, but it does serve as a reminder to weight your stocks within your portfolio correctly according to their risk. Now, I still do believe that Bill Foley can turn Paysafe around, and therefore I'm not considering this an investment failure yet. I'm a long-term investor, and it wouldn't be the first time that I've seen a stock go down by 30%, only for it then to go up by 100%, and who knows, that might happen with Paysafe. But the point that I am making here is that clearly the digital wallet segment hasn't played out over the last couple of quarters as I expected that it might. And therefore, I'm definitely going to keep a close eye on the digital wallet segment over the next couple of quarters and hope that the business starts to turn around towards the back end of 2022, which to some people might seem like a long time to wait on a stock, but this is long-term investing and a year in this game is not very long at all. Anyway, guys, I hope you found the video useful, and until next time, thank you.